Hi. Let's learn about the ascending triangle pattern. An ascending triangle is a chart pattern used in technical analysis. It is created by price moves that allow for a horizontal line to be drawn along the swing highs and a rising trend line to be drawn along the swing lows. The two lines form a triangle. Traders often watch for breakouts from triangle patterns. The breakout can occur to the upside or downside. Ascending triangles are often called continuation patterns since price will typically break out in the same direction as the trend that was in place just prior to the triangle forming. An ascending triangle is tradable in that it provides a clear entry point, profit target, and stop-loss level. It may be contrasted with a descending triangle. An ascending triangle is generally considered to be a continuation pattern, meaning that the pattern is significant if it occurs within an uptrend or downtrend. Once the breakout from the triangle occurs, traders tend to aggressively buy or sell the asset depending on which direction the price broke out. Increasing volume helps to confirm the breakout, as it shows rising interest as the price moves out of the pattern. A minimum of 2 swing highs and 2 swing lows are required to form the ascending triangle's trend lines. Here an ascending triangle forms during a downtrend, and the price continues lower following the breakout. Once the breakout occurred, the profit target was attained. The short entry or sell signal occurred when the price broke below the lower trend line. A stop loss could be placed just above the upper trend line. Wide patterns like this present a higher risk, reward than patterns that get substantially narrower as time goes on. These two types of triangles are both continuation patterns, except they have a different look. The descending triangle has a horizontal lower line, while the upper trend line is descending. This is the opposite of the ascending triangle, which has a rising lower trend line and a horizontal upper trend line. The main problem with triangles, and chart patterns in general, is the potential for false breakouts. The price may move out of the pattern only to move back into it, or the price may even proceed to break out the other side. A pattern may need to be redrawn several times as the price edges past the trend lines but fails to generate any momentum in the breakout direction. While ascending triangles provide a profit target, that target is just an estimate. Like other chart patterns, ascending triangles indicate the psychology of the market participants underlying the price action. In this case, buyers repeatedly drive the price higher until it reaches the horizontal line at the top of the ascending triangle. The horizontal line represents a level of resistance, the point where sellers step in to return the price to lower levels. When you identify a continuation pattern on a chart, it suggests that the price of the asset has a greater likelihood of emerging from the pattern in the same direction that it was moving previously. There are several continuation patterns, including the ascending triangle, that technical analysts use as signals that the existing price trend will likely continue. Support and resistance levels represent points on a price chart where there is a likelihood of a let-up or a reversal of the prevailing trend. Support occurs where a downtrend is expected to pause due to a concentration of demand, while resistance occurs where an uptrend is expected to pause due to a concentration of supply. Traders generally enter a position on a security when its price breaks above or below the boundaries of an ascending triangle. If the price jumps above the horizontal resistance level, it may be a good time to buy, while a move below the lower trend line suggests that selling or shorting the asset could be a profitable move. Traders often protect their positions by placing a stop loss outside the opposite side of the pattern. An ascending triangle is a technical analysis chart pattern that occurs when the price of an asset fluctuates between a horizontal upper trend line and an upward-sloping lower trend line. Since the price has a tendency to break out in the same direction as the trend in place before the formation of the triangle, ascending triangles are often called continuation patterns. Traders often wait for the price to break above or below the pattern before entering a position. The ascending triangle pattern is particularly useful for traders because it suggests a clear entry point, profit target, and stop-loss level. Here are 6 key takeaways. 1. The trend lines of a triangle need to run along at least 2 swing highs and 2 swing lows. 2. Ascending triangles are considered a continuation pattern, as the price will typically break out of the triangle in the price direction prevailing before the triangle, although this won't always occur. A breakout in any direction is noteworthy. 3. A long trade is taken if the price breaks above the top of the pattern. 4. A short trade is taken if the price breaks below the lower trend line. 5. A stop loss is typically placed just outside the pattern on the opposite side from the breakout. 6. A profit target is calculated by taking the height of the triangle, at its thickest point, and adding or subtracting that from the breakout point. Hope this would help. Thanks for watching.